Most people misunderstand investing after the age of 70. They believe that reaching this stage of life means abandoning all growth, pulling money out of markets, and placing everything into cash or ultra-low yield accounts. That idea feels safe, but in reality, it can be one of the most dangerous financial decisions a retiree can make. The truth is simple. Safety is not about avoiding markets entirely. Safety is about protecting purchasing power, generating dependable income, and reducing the risk of permanent loss. When you are over 70, the rules do change, but not in the way most people think. At this stage of life, time becomes your most limited resource. You cannot afford long recovery periods after major market downturns. You need stability now, income now, and protection against inflation that silently erodes wealth year after year. This is not about chasing high returns or speculative opportunities. It is about designing a portfolio that works quietly and consistently in the background, allowing you to live comfortably without constant financial anxiety. To understand why this matters, consider what happens during severe market stress. In major financial crises, even high-quality assets can fall sharply. Investors who are still working can wait. Retirees often cannot. Income needs do not pause during downturns. Expenses continue. That mismatch between falling portfolio values and ongoing withdrawals is what destroys retirement plans. This is why investing after 70 requires a fundamentally different approach. The objective is no longer aggressive growth. The objective is threefold: preserve capital, produce a reliable income, and allow modest growth to offset inflation over a long retirement horizon. Many people underestimate how long retirement lasts. Living another 15 to 20 years is common, and longer lifespans are increasingly normal. Over that time, even moderate inflation can significantly reduce purchasing power. Holding large amounts of idle cash may feel safe, but it quietly guarantees a loss in real terms. Inflation compounds just like interest. A small annual erosion becomes devastating over decades. Real safety means protecting against that erosion without exposing yourself to catastrophic market risk. The foundation of a sound retirement strategy begins with assets designed to preserve purchasing power. Government-backed, inflation-adjusted instruments exist for this exact purpose. These investments are not exciting, and that is precisely why they work. They adjust with inflation, ensuring that income and principal maintain real value over time. For retirees, inflation protection is not optional, it is essential. A meaningful portion of a retirement portfolio should be allocated to this foundation. This creates stability and predictability regardless of economic conditions. Structuring these assets across multiple maturity periods further reduces risk and maintains flexibility as interest rates change. The second pillar focuses on ownership in high-quality businesses with long histories of paying and increasing cash distributions. These are not speculative companies dependent on rapid growth. They are established enterprises providing essential products and services, capable of generating steady cash flows through multiple economic cycles. Rather than selecting individual companies, broad diversification is critical. Holding a wide basket reduces the impact of any single business encountering difficulties. The power of this approach lies in growing income over time. While initial yields may appear modest, the consistent increase in payouts helps offset inflation and supports long-term financial stability. One rule matters above all else here: never chase high yields. Extremely high payouts often signal distress rather than opportunity. Sustainable income comes from quality, not from temptation. The third component introduces predictable income through lending to financially strong organizations for shorter periods. Short-term, high-quality bonds provide contractual income and reduce sensitivity to interest rate changes. This matters deeply in retirement.
Large price swings in long-duration assets can be unsettling and unnecessary. A structured maturity approach allows capital to return regularly, providing liquidity without forcing sales during unfavorable market conditions. This design supports income needs while maintaining flexibility as interest rates change. The fourth element adds exposure to real assets that generate income from essential services people rely on regardless of economic conditions. Certain real estate categories provide durable demand, contractual rent increases, and long-term relevance. These assets can offer higher income than traditional stocks while adding diversification to the overall portfolio. This allocation should remain moderate. Real assets can fluctuate, but when selected carefully and diversified, they contribute income and inflation resilience without dominating risk. When combined, these four components work together as a system rather than isolated investments. Each serves a distinct purpose: inflation protection, income growth, stability, liquidity, and diversification. The result is a portfolio designed not to impress, but to endure. A balanced retirement allocation prioritizes defense over excitement. It acknowledges that markets will fluctuate, interest rates will change, and headlines will generate fear. What matters is not avoiding volatility entirely, but ensuring that income continues and principal remains intact through inevitable cycles. One of the greatest threats retirees face is not poor long-term returns, but poor timing. Experiencing significant losses early in retirement while withdrawing income can permanently damage a portfolio. This is known as sequence risk, and it destroys otherwise reasonable plans. Reducing exposure to severe early losses dramatically increases the odds of long-term success. Tax efficiency also plays a critical role. Where assets are held can be just as important as what assets are held. Structuring income-producing investments in tax-advantaged accounts while placing growth-oriented holdings where they compound efficiently can meaningfully improve outcomes over time. Small differences compound into large ones across decades. Simplicity is another form of protection. Complex strategies increase the risk of mistakes, especially as decision-making becomes more difficult with age. A clear, understandable structure makes it easier to maintain discipline and avoid costly errors. Consolidation, automation, and regular but infrequent review help preserve clarity and control. Safeguards should be established early. Trusted individuals, clear documentation, and simplified systems protect against both market risks and non-market risks, such as fraud or cognitive decline. These precautions are not pessimistic, they are responsible. A practical plan begins with understanding actual income needs, building a cash buffer for short-term expenses, and allocating remaining assets thoughtfully across defensive, income-producing components. Regular rebalancing keeps risk aligned with intention, while ignoring daily market noise preserves emotional stability. This approach is not designed to generate dramatic stories or short-term excitement. It is designed to deliver peace of mind, consistent income, inflation resilience, protection against catastrophic loss. By the time you reach your 70s, the objective is no longer to win the game. You've already played it successfully. The objective now is to protect the result, to ensure that what you built continues to support you for the rest of your life. True financial security doesn't come from prediction or boldness. It comes from quality, diversification, discipline, and patience. That is what allows wealth to last. That is real safety. That is real freedom.